starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to the LSA webinar. This is Brad Casper, President and CFO of LSA Portfolio Analytics. We have an exciting call for you set up today. On the phone with us is Brian Wesbury. And for those of you that aren't familiar with Brian, Brian is the Chief Economist at First Trust Advisors just outside of Chicago in Wheaton, Illinois. To give you a little bit of Brian's background, Mr. Wesbury has been a member of the Academic Advisory Council for the Federal Reserve Bank of Chicago since 1999. In 2012, he was named a fellow of the George W. Bush Presidential Center in Dallas, Texas, where he works closely with its 4% growth project. He's been seen in every type of publication that you can imagine out there: Bloomberg, CNBC, BNN, Canada TV. And as I understand is he was just rushing out of the studio with an interview with Fox News. So it's a great honor to have Brian with us today. Some of you that have been a part of the LSA program for years might know as well, Brian was a keynote presenter for us at the LSA National Conference back in 2012. And he continues to be a great source of information to the LSA team. So Brian has joined us today to discuss the current markets. And really to dig into a little bit about how his plow horse economy concept is holding up in this ever-changing economic environment. So Brian, with that introduction, I'm going to turn the platform over to you. And once again, thank you so much for joining us today.
You are welcome, Brad. Thank you very much. Thanks for that introduction. And I think I probably used plow horse back in 2012 when I was with you, and it still holds to this day. And so I want to update everybody on my thinking and talk about the last couple of years. And as you can see on the slide presentation, we begin with a slide about monetary policy. But before I get to that, I kind of want to go back. It's about 2 months. Actually, I was on Fox Business with Liz Clayman, and she kind of came at me out of the blue. We had our 3 topics that we were going to talk about, but all of a sudden she launches in this interview with a question. She's like, Brian, what do you think about the 2 black swans that have happened this week? And I was shocked. I'm like, 2 black swans this week? What are they? And she says, well, it's the drop in copper prices. Now, I get paid to know these things, and I didn't know that had happened. But nonetheless, that was a black swan to her. And then it was the week of the Swiss franc. So she was the Swiss franc. The Swiss revalued their currency versus the euro. And so everybody remembers that. But and I didn't know how to respond to this because, in my mind, neither of these are black swans. But the bottom line is, I said to Liz, I said, look, that makes 251 or 252 black swans that we've had in the past 6 years. Everyone wants and sees black swans. We have flocks of black swans, and I think there's a couple of reasons for this. First of all, people are still terrified, so it's kind of like having PTSD, right? If you hear a backfiring car, you want to dive in the foxhole, and that was the trauma of 2008, and people are still jittery. There's no doubt about that. But I also think that lots of analysts and journalists and pundits and talking heads want to be the one that calls the next black swan, and if somehow they can do this, they're going to become famous. And so as a result, we hear about black swans every day, and we all know what a black swan is, right? It's the tail. It's 6 standard deviations away from the norm. It's something that no one expects and that takes down the world. And I actually believe what we've been living with here for the past 6 years is really the golden goose, if you will. And I know these are mixing metaphors here with horses and birds, but the bottom line is that the economy has grown for the past 6 years. The stock market is up for the past 6 years, and it has been an amazing period of time. Yes, the economy has grown more slowly than we would have hoped than it has in the past. That's why we call it the plow horse economy. Nonetheless, the economy has done extremely well given the burdens that have been placed on it. Now, what lots of people kind of believe, if you will, is that, oh, you know, Wesbury, you've been optimistic, you've been talking about this plow horse, you've been telling us the stock market's going up, and I guess you could say you're right, but you're really just lucky. And really this isn't anything to do with a good economy. It's all because of the Federal Reserve. And so if you look at this very first chart that I'm adjusted monetary base in M2, the blue line is the monetary base. You can see the 3 steps up, QE1, QE2, QE3. The Federal Reserve did at least $3.5 trillion, a little bit more, of bond buying over the past 6 years. And people say, see that blue line? It's going up, and that's why the stock market line goes up, and that's why the economic growth line goes up too. This is all a sugar high. It's caused by monetary policy, and I don't agree with this. I believe this is a bad analysis, and there's a couple of reasons for this, or ways that I can defend my position. And the first is real simple, and that is when the Federal Reserve buys bonds, and this has been true from 1913 when the Fed was first put in place all the way until 2008. Every dollar the Federal Reserve spent to buy bonds, printed a dollar, bought a dollar's worth of bonds, the banking system took that dollar, lent it out, started multiplying it, invested it, and the banking system grew by some multiple of the Federal Reserve's injection of new money. And this was true all the way up until 2008. And as you can clearly see in this chart, yes, the Federal Reserve's monetary base, the blue line, their bond buying went through the roof, but the banking system itself, and the best measure of its size is the M2 measure of money. Just to remind you, this is all checking accounts, all savings accounts, CDs, cash, all currency and near currency type of products, cash on hand. M2 is all deposits in all banks. The bottom line is that number, that measure of the money supply did not accelerate. In fact, since 2008, it's grown about 6% a year. That's exactly the rate of growth it grew between 1995 and 2008. The monetary base grew 25% a year, but banks never took this money and lent it out. In fact, it's sitting, all that blue line, the difference between the two, is sitting in banks, and it's being held as excess reserves. Banks never lent it out. And that's why I can say that the Federal Reserve is not the driver of this economy. Milton Friedman always told us to follow M2, and when I do that, it tells me that the money supply has not been the driver of growth. In fact, if you think back, all the people who said that when we looked at quantitative easing, it was going to cause hyperinflation, it was going to cause a collapse in the value of the dollar, and yet none of that has happened. And so what's fascinating about this to me is that all of those predictions that people made haven't come true. One of the other interesting things that I've seen is kind of this use of quantitative easing to justify whatever you want. So, for example, the Wall Street Journal editorial page, they say, well, QE1 might have been necessary in the middle of the panic, but QE2 and 3, not only weren't they necessary, but they really haven't worked. Economic growth hasn't been strong. And at the same time, they say, well, but we know that QE has lifted asset prices. So therefore, what they're saying is somehow QE can lift asset prices, but it can't lift growth. Ben Bernanke, in a recent column, said, well, QE has worked because it lowered unemployment, but yes, the GDP has been growing slow, but that's because productivity has been growing slow. It has nothing to do with QE. If QE tried to lift GDP, but productivity was slow. So what's fascinating is that everyone has this very Fed-centric view of our world, where if there's something going up, then it must be because of QE. If there's something not going up, it can't have anything to do with QE. And so the bottom line is I think people make a lot of mistakes. I follow that orange line, M2, and what it says is that we should not have had hyperinflation, that the economy should have continued to grow. However, there was going to be no special acceleration. Now, that brings me to the second point. Okay, Wesbury, if it's not QE that's driving the economy, what is driving the economy? And I want to take you to this next chart. Brad, I'm using, maybe I have to click on that. There we go. It's a picture of real business investment as a percent of GDP. Now, one of the fascinating things that we hear all the time is that businesses aren't investing. They're just sitting on cash. They're paying shareholders back through dividends or buying stock. They're buying other companies, but they aren't investing. And I'd like you to take a look at this chart. You know that's not the opposite of fake. That's inflation-adjusted business investment is at a record share of GDP. Now, how can these two things be true? How can I show you this chart and have record high investment and yet have people say we're not investing? And the reason people say we're not investing is that they're looking at nominal spending. But let me give you a quick example. An Apple iPhone 6, there's three versions of it, 16, 64, and 128 gigabytes of flash memory. The mid-range phone has 64 gigabytes of flash memory, and that phone you can get for $199 or less, and a 2-year plan. Now, somebody did this the other day. They went back to 1991 and gathered all the Radio Shack ads that they could find, and they said, well, if you bought a camera and a flashlight and a phone and an alarm clock and everything else that's in that phone, it would have cost you $3,000. So you're getting $3,000 worth of 1991 stuff for $199, and that I'm jealous of the Economist who did this. That's a great analysis. It makes the point, but I'm going to tell you that understates it massively, because in 1991, flash memory was a brand new technology, and 1 gigabyte of flash memory in 1991 cost $45,000. If you take 64 times 45,000, it's 2.88 million. So in fact, for $199, you are getting a $3 million phone, and that's what this chart tries to measure. Now, I'm going to tell you, our government doesn't measure it very well. It is not 3 million to 199. It's more like 500 to 199 here. But even an inadequate measure of the true gains in real investment shows that we're at an all-time record high. Walgreens can build an app that connects all its stores, all its customers, your pharmacy, your physician, all of that stuff for less than the cost of the inventory in one of their 8,000 stores. That app is way more valuable than selling all the inventory in one of their stores. So small investments get you great returns today. One last quick point about this new technology economy. Uber, the last valuation I saw was $18 billion. They're trying to raise money right now at a $50 billion valuation. That means that Uber is worth more than all the rental car companies combined, and it owns no cars. And there's a key fact here, and that is that who owns the cars? The Uber driver owns the car. So my last Uber driver, Wendy, she had a VW Passat. When she went and bought that from the dealer, what was it counted as? It was counted as private consumer spending. It wasn't counted as business investment. So if you think of all the drivers for Uber, and this is just one example, they buy their car really as an investment so that they can drive for Uber, but it gets counted as personal consumption. And what that does is it actually drives the savings rate down. It makes it look like consumers are spending more of their income. It doesn't show up in business investment, so it lowers those numbers. So even this real business investment number understates investment, as I said before. And so what I believe is driving our economy today is this investment. It's actually new technology, and we are living in one of the greatest periods of new technology the world has ever seen. Fracking has driven the price of oil from over $100 a barrel down into the 50s, high 50s. 3D printing, robotics, the cloud, smartphone, tablets, apps, all of these things are brand new technologies. Well, fracking's been around a long time, but we put together everything: the seismic testing, the ability to horizontal drill, the ability to see what's going on down there. All of that technology has come into being literally combined in the last 6 years, along with all these other new technologies. And what we've seen is a massive pickup in productivity and efficiency. And I know you hear all the time that productivity isn't rising, but I can prove to you that productivity is rising. You know, Larry Kudlow says profits are the mother's milk of capitalism. And whenever he says that, I always say, wait a minute, who's the mother? And the mother is productivity and efficiency. That's where profits come from. Companies that increase productivity, increase efficiency, they generate profits. And that brings us to this next chart, corporate profits. The bottom, if you look at those blue bamboo sticks going to the moon, we have record high corporate profits in America today. The last 3 quarters, if you average them out, record high. And they would not exist if productivity and efficiency weren't increasing. Now, that little red haze at the bottom, those little red bars at the bottom, that's profits from petroleum and coal. They are 2% of overall corporate profits. And so anyone worried that the drop in oil prices is going to be bad because it's going to reduce earnings and hurt the economy, it's just not enough to take us away from record high corporate profits. And that brings me to a point about the S&P 500. This is economy-wide corporate profits, the chart that you're looking at. S&P 500 has 14% of its size, of its market cap has come from oil companies historically, or at least in the last few years, and it's overweighted relative to the economy as a whole. So if you're looking at overall S&P earnings and saying they're declining and therefore PE ratios are up, that overstates the impact of oil. If you take out energy from the S&P 500, what you find out is that the S&P is still cheap. Let me give you my forecast for right now. I want to tell you that we anticipate interest rates going up. And when interest rates go up, we expect actually the Fed to raise rates. I still think it could happen in June, but it doesn't really matter whether it happens June, July, August, September. The Fed's going to raise rates. They're just going to be less loose. They won't be tight, not for a very, very long time. They're going to go slow. But this is going to drive the 10-year yield up, the 20-year yield up, corporate bond yields up. And when we allow for this, we actually put a higher interest rate in our stock market model. We put a 4% 10-year treasury. That's double where it was just a couple of weeks ago. And it says that the S&P 500, even with the decline in oil profits and energy profits, is still 22% undervalued. So I was bullish back in 2012 when I spoke for LSA, and I'm bullish today. And so the bottom line is that these corporate profits are driving our economy, not quantitative easing. Now, let me close up by sharing with you what I call my 4 pillars of prosperity, and that is, I just told financial advisors that the market's cheap. You're going to literally have people's lives in your hand tomorrow, this afternoon, this evening, their kids' education, their retirement. I mean, this is important stuff, and I don't go to bed easily, you know, without thinking, gosh, I hope I'm right. I want to be right. And so what do I look at to determine whether you know, how do I get to sleep? People ask me that all the time. And it's the 4 pillars, and they are this. Number 1 is monetary policy. Number 2 is tax policy. Number 3 is trade policy. And then number 4 is spending and regulation. These are the things that change the direction of monetary policy, not the Swiss franc, not the price of copper, not flocks of black swans. It's these things. And so when I think about these today, let's talk about monetary policy first. Monetary policy, today the Fed's at 0 with its interest rate. It still owns $3.5 trillion more bonds than it did 6 years ago. There's $2.5 trillion of excess reserves in the system. I don't care whether the Federal Reserve sold $1 trillion worth of bonds and raised interest rates to 1% tomorrow. There would still be plenty of liquidity in the system. Now, I don't like QE. I don't like the Federal Reserve's regulatory reach these days. So I can't give monetary policy a big plus, but I'll give it a small plus. It's not a negative for growth. Milton Friedman taught us that the Fed contracted the money supply in the 30s. That's why we had the Great Depression. We don't have that today. Tax policy, look, we raised tax rates in 2012. The Bush tax cuts expired then. We've got a couple of surcharges from Obamacare. Dividend tax rates are actually lower than they were in the 1990s, but in the late 90s during the boom. But the other tax rates are about where Clinton had them in the late 1990s. So don't get me wrong, this is not a great tax policy. We should have tax reform. I'd love to see a flat tax, but it's not a great tax policy, but it's not an awful one. I'm not going to give it a big plus. I'll give it a small plus. So that's a small plus on monetary policy, a small plus on tax policy. Trade policy. Sure, we're in this debate right now. Harry Reid may not give Obama his fast-track authority. Rob Portman from Ohio is doing the same thing. He's fighting against this too. So we'll see what happens. But the bottom line is we're negotiating too. Nobody's talking about getting protectionist. In fact, we're easing up export rules on energy. We've been moving this way for 40 or 50 years. Trade policy actually gets a big plus for me. So we have 2 small pluses and a big plus. It's spending and regulation that I'm most worried about. Government spending has grown massively. The sequester helped cut it back, but still government's too big. And regulation, clearly, Obamacare, Dodd-Frank, EPA, all of that stuff, none of that is good. I'm going to actually give that a negative, but it's not a huge negative because we do have a divided government, and that sort of means that we're stuck where we are. Government is smaller than it was 4 or 5 years ago. But the bottom line, when you just look at spending, that is, and so it gets a little negative. So at the end of the day, I have 2 small positives, a big positive, and then a small to middly negative. And when I look at that, it's easy to go to sleep because that's not the kind of environment that creates a turn in the economy in a massively negative way. So I think the economy will continue to grow. Spending and regulation are holding that growth back, so it's going to be a plow horse economy, but new technologies will continue to raise productivity, efficiency, and investment, even though lots of people tell you investment's not rising. It is, because very small outlays can increase productivity and efficiency in a huge way. That's the world we live in today, and it's only getting better. And so the stock market's undervalued. I do think the bond market is overvalued. I think this rise in interest rates we've seen in the past couple of weeks will continue. Probably not as fast, but I do expect interest rates to be higher, 0.5% to 1%, 12 months from now across the yield curve. But I also expect the stock market to be higher as well. So, Brad, I'm going to end it there, and I really appreciate everybody listening. I hope I haven't droned on too long. And if you have some questions, Brad, I think we have the ability to get those, and I can answer them.
We do, Brian, and first of all, thank you for the recap here and outlook. To build on this a little bit, we are hearing more and more economists talk about the importance of more of a global investment inside portfolios. Do you still see the same type of value opportunities that exist beyond just the U.S.? And if so, can you talk a little bit about that, or even elaborate a little bit in terms of the ECB now pumping money into the Eurozone, and what implications you think that has, or is it the same as what we've seen here in the U.S., just in a different time?
Sure. I do believe that Europe is as a whole is cheap. If you look at companies in Europe on a price to book or price to sales or price to earnings basis, they're cheaper than stocks are in the United States. We're not expensive here, but they're a lot less expensive. And so I actually like Europe as an investment. Now, I am not buying Europe because of quantitative easing. I'm buying Europe because they're good companies with good management in a great entrepreneurial, innovative, creative environment that we live in today. And what I mean by that is that small outlays on new technology can have huge returns. Siemens may be headquartered in Germany, Porsche, BMW. These are all great companies. But they do business all over the world. Siemens actually has more employees outside of Germany than inside. So are you really buying Europe, or are you buying the world? I would argue that Europe itself is, if the U.S. is a plow horse, Europe is a plow horse with shin splints. All right, and what I mean by that is that their government's even bigger, their tax rates are even more of a problem. Greece is a basket case, and so I don't expect great economic growth out of Europe. I don't think they're going to be in a massive recession, but I do think their stocks can rise just like ours have here, even with a relatively slow growth economy. Japan, personally, I don't like Japan at all. I think all these arrows and government activity and tax hikes and QE. QE is not Japan's been doing QE for 25 years, and if that's not enough evidence that QE doesn't work, I don't know what is. Yes, their stock market's gone up, and yes, they did QE, but do two lines going in the same direction mean that one caused the other? I don't believe so. I like emerging markets. I think, like I said, our world is in a great new entrepreneurial era. It has been for the last 25 years, and I also think the pendulum in the world politically is beginning to swing back to the right. I think that's what Cameron's election in the United Kingdom signals. I think that's what the Republicans' victory in the November 2014 elections were all about. And so that tells me that I do want to own undervalued areas of the world, and I like Europe, and I like emerging markets, and I also like the U.S.
Brian, you just mentioned Greece, and given that there's a big deadline that's right around the corner here, what do we do with Greece? I mean, they continue to be in the headlines. They continue to kind of pester us. What's your take on this? If they default, are they out? And what are the ramifications felt not only in Europe, but I guess here in the U.S. as well?
Yeah, this is obviously on lots and lots of people's minds, and I'm not quite sure how to say it succinctly other than it's not a black swan. Greece is about the size of Dallas, Texas. It Greece peaked in 50 BC, you know, so this idea that somehow it's going to take the world down, I think it's just crazy. In fact, its GDP has already shrunk 30%, and nobody even knows it. And so, I mean, it's already in free fall, and so if somehow defaulting was going to cause that, we should have. And by the way, all this is priced in too. Greek banks own about 75% of all Greek debt. The other 25% is mostly owned by the ECB and the IMF. There is not a set of dominoes that is about ready to fall. Greece can go under, just like Detroit, just like Illinois might, and I think the world will go along just fine. I mean, Cyprus collapsed, Ireland collapsed, Iceland collapsed, you know, so Zimbabwe collapsed. There's no. I get it that people are scared, but they're scared of everything. People are scared of their shadow, and Greece is their shadow.
Yeah. So a little while back, Brian, you had tweeted that you had the pleasure of doing a 30-minute interview or something along those lines with the former Fed Chairman Ben Bernanke. Can you give us some insight of what that interview was like and what type of points you kind of pulled away from that conversation?
Sure. You know, so this was down in Sarasota, Florida. He got paid $250,000 for 2 speeches. I got paid. In fact, I had to pay for my airfare to get there. But nonetheless, I want his gig. And he spoke for about 20-25 minutes, and then he sat down for a 30-minute Q&A with me. And the reason they did that is they wanted an economist to ask questions. So there's kind of two. I decided I wasn't going to argue with him, like, you know, just, you know, he had just given the speech, he had everybody laughing, and they liked him, and he's a really nice guy. He's unassuming, but you know, obviously whippersnap smart, and they like. I wasn't gonna. Okay, now come over here, and I'm gonna fight you. It wasn't my TV show, so I decided to be nice, but I did ask questions. So here's one of the questions that I asked. I said, hey, the Federal Reserve has bought all these bonds, and the Fed's balance sheet is now 26% of GDP. It's the biggest it's ever been. It's bigger. The Fed's balance sheet is bigger than the annual federal budget. Isn't this kind of, I mean, don't you understand why Congress is coming after you and wants to regulate you and wants to audit you and all those kinds of things? He goes, no, I don't understand that. You know, he made fun of Congress, but this is one of the things he said. He said, you know, if you look at that 26% of GDP, that's nothing. I mean, Japan, he said, their central bank is 50% of GDP. It's way bigger than the U.S. And I bit my tongue, but my response was going to be, you know, well, how'd that work out for them? I mean, because they've been in a recession for going on over 20 years, and so I found it. Now I hoped the audience understood that. I wasn't going to pick on him for saying that, but I brought that out. So he basically said, "Oh yeah, I mean, come on, we're small compared to other central banks," and I found this fascinating. The Fed is not, they like being big, and I think they're going to go real slow in selling bonds. Number two thing that I took away is I asked him, well, you know, you have all these excess reserves in the banking system, so aren't you a little worried that banks might use those reserves and start lending them out and create bubbles and all kinds? He goes, well, you know, we can deal with that by raising interest rates that we pay banks, and we can raise them far enough so that they don't lend. And one of his lines in his speeches was, in fact, it was an applause line, was that the Federal Reserve had paid the Treasury $500 billion of interest that it had earned over the last 5-6 years because of QE. And this guy, and he said that when we lowered the deficit by $500 billion, and this was applauded. I mean, people applauded it. But then he said, well, we'll just pay the banks more on their excess reserves, and that'll keep them from lending this money out. And once again, I bit my tongue because the response to that would be, well, if you pay the banks more, then that means you're paying the Treasury less. And so isn't that kind of fascinating that you'd be, that one of your, you won't get applause anymore because now you're paying all that money to the banks. And by the way, I don't even think that would work because if you can make a 3.5% mortgage or 4% or 4.5% mortgage and the Fed's only going to pay you 50 basis points or 75 basis points, is it really, I mean, wouldn't you be smarter to make the loan? And so anyway, the bottom line is that it was fascinating. I think I brought out some of the concepts, but I did it without arguing, and I'm not sure how many people really understand monetary policy. One of the last points that he said, I said, well, one of the other ways that you can stop banks from lending is use what you call macro-prudential policy tools. In other words, if you think there's a bubble in house lending, then you're going to go in and slow it down. And he goes, well, that's exactly right. He goes, in fact, in Europe right now, in the United Kingdom, that's exactly what they're doing. They're demanding bigger down payments, and they're trying to slow the housing market down. To me, having the Fed do this it's just overkill. We should not have the Federal Reserve running the banking system. What they should be doing is making sure there's not excess liquidity in the system so we don't get bubbles. But nonetheless, that's what he said, and he seemed to be enamored by what the United Kingdom is doing. And I reminded him, I did tell him this. I said, well, that's the opposite of what we did here in the United States, because back in the early 2000s, we were telling Fannie and Freddie that they needed smaller down payments. And that led to the housing bubble, and he kind of agreed. He was like, well, yeah, that's true, but we've learned our lesson. And anyway, it was kind of fascinating interview. I knew where he was coming from, but he defended to the end what the Fed did, and he truly believes that they saved the world. I don't, but nonetheless, he does.
Okay. Well, I'll tell you what, Brian, we're right at our 40-minute mark, and again, I just want to personally thank you on behalf of LSA for giving us some time today. We could go on with questions for hours, and hopefully maybe later this year we can pull you back in to do a little bit of a follow-up to see how the Plowhorse economy continues to progress throughout 2015. For everyone that joined us on the call today, we appreciate it. We are excited to announce as well that the LSA beta site is up and running. We will slowly be progressing everybody into the new format of the website over the coming weeks, where you can also find great commentary from professionals and economists just like Brian Wesbury. So with that said, again, Brian, thank you so much to everyone that joined us. We appreciate the time. If you have any questions, always feel free to give us a call at 866-581-5724, or you can email us at support@lsaportfolios.com. Thank you so much to everyone.
Thanks, Brad.